All right, let's dive into one of my favorite chart patterns, one that's incredibly powerful for spotting when a stock's momentum is about to shift in a big way. We're talking about the bump and run reversal top.
I mean, that's the dream, isn't it? What if you could see a price drop coming before it actually hits? That exact question, that search for an edge, is what led to the discovery of the very pattern we're breaking down today.
You know, the story behind this one is pretty great. After getting buried in all sorts of complex math, the guy who found this, Thomas Bulkowski, just decided to look at the charts. He was hunting for a simple visual clue that showed up right before a stock took a nosedive, and he found one. His first name for it? BARF, Bump and Run Formation. Yeah, he wisely figured that might not catch on, so he renamed it the Bump and Run Reversal. Much better. So what exactly is a bar top? Think of it as a story of market psychology playing out right on your screen. It shows you the entire arc, from a steady, enthusiastic rise to a crazy speculative frenzy, and then, boom, a powerful reversal where fear takes over and the selling begins. It's a classic sign that the bears might be taking control.
The best way I've found to visualize this pattern is to picture a mountain range. It's not just some random spike up and down. No, it has a very specific three-part structure that tells a complete story about that stock's journey. Let's take a look at how that unfolds.
And here it is. This is the classic shape. You can clearly see that gentle beginning, right? Then that dramatic, almost frantic peak and the sharp, punishing decline that follows. It's this entire journey from start to finish that we need to train our eyes to see.
Okay, so let's break this down into its three parts. First, you've got the lead-in phase. Think of these as the gentle foothills. The price is just climbing steadily along a trend line. Then you get the bump phase. That's the mountain itself. This is where speculation goes into overdrive and the price just rockets upward. And finally, you have the downhill run, the descent, where the party's over and the price comes crashing back down through that original trend line.
Now here's the thing. Not every chart that pops and drops is a real bump and run. There is a very strict checklist you have to follow to identify it correctly. This is how we, as traders, separate a true actionable signal from all the random noise out there. These are the non-negotiables, right? First, you've got to use an arithmetic scale, not a log scale, or you just won't see it properly. That lead-in trend line, it has to be rising, ideally between 30 and 45 degrees, because that shows real investor interest. And that phase needs to last at least a month to be significant. The bump itself should be kind of rounded, showing momentum is slowly dying out. But honestly, that last roll, that's the most important one of all.
And this is it, the 2-to-1 rule. This is everything. This is the mathematical signature of unsustainable hype. It tells you that the price accelerated away from its healthy trend at a rate that just can't last. It's pure FOMO, fear of missing out, kicking in. If you don't have this specific ratio, you don't have a valid BAR pattern. Simple as that. It's the key that unlocks the whole thing. So here's how you actually measure it. You take the height of the lead-in phase, from its highest point down to the trend line. Then you do the same for the bump, measuring from its peak all the way down to that same trend line. Just like you see here, if that bump is at least double the height of the lead-in, ding, 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 the rule is met and the pattern is confirmed.
But let's get real for a second. No pattern in trading is perfect. They're not foolproof. They can fail, and sometimes they show up looking a little different. Understanding these quirks is just as crucial as knowing the textbook version. So on the left, you see that classic rounded top. Pretty standard. But look at the right. That's a common variation called a dual bar. This is what happens when the price falls back a bit, but the bulls make one last desperate attempt at a new high before it finally gives up. The story is the same. It just has a little plot twist before the end. And what does an outright failure look like? Well, the data shows that if the price breaks that trend line, but it drops less than 5% before it recovers and starts rallying again, we call that a 5% failure. This is a super important number for managing your risk, and it's a great reminder that you always wait for confirmation. Okay, so we've covered the theory, we know what to look for, now let's get to the fun part. How do we actually use this pattern to make trading decisions? Let's talk tactics. This is the question, right? It's a beautiful looking pattern, but does it actually predict anything? Let's take a look at what the performance numbers have to say. And the results are, well, they're pretty darn compelling. In a bear market, the average drop after a confirmed BAR pattern is a whopping 27%.
And even in a raging bull market, you're still looking at a very respectable average decline of 19%. These are not small moves. And it's not just about the size of the drop, it's about how reliable it is. This pattern has a predictable price target. And get this, in a bear market, it hits that target an incredible 90% of the time. Even in a bull market, it's still a solid 78%. That tells you this pattern isn't just a fluke, it's got real statistical backing. So the big question is when to act. This is where we can use a couple of parallel lines to guide us. You draw a warning line that's one lead-in height above the trend. When the price crosses that, you're on high alert. The sell line is drawn 2 lead-in heights above. That's when your 2-to-1 rule is met and the pattern is officially confirmed. For many, the real sell signal is when the price falls all the way back down and breaks below that original trend line.
And at the end of the day, remember this classic bit of wisdom. The goal isn't to time the absolute top tick. That's a fool's game. The goal is to identify a high probability setup, capture the meat of the move, and manage your risk. And the BARR pattern gives you a fantastic framework to do just that.
So, what's the big takeaway here? The bump and run reversal is not a crystal ball. It's a visual fingerprint of a miniature market bubble inflating and then popping. It's a roadmap of a very predictable human story, the journey from rational enthusiasm to irrational greed, and then finally to panic.
Look, every pattern on a chart tells a story. The bump and run tells one of the most dramatic ones out there. But it makes you think, doesn't it? If the story of enthusiasm turning to fear is so clear, what other stories, what other insights into human behavior are just waiting for us to find them, hiding in plain sight on the charts?